Thanks for tuning into Profit Insights, and this promises to be a fairly insightful conversation because it's on the back of a report that Nomura, a team of Nomura analysts have written, and the report is titled Asia's New Flying Geese. And lest this make you wonder what we're talking about, we're talking about beneficiaries of a shift in supply chain globally and how some of Asia's economies could be potential beneficiaries of this. One of the authors of this note, Sonal Verma, is with us in our studios to talk about this. Sonal, great having you. Thanks for taking the time out.
Thank you for having me.
No, the pleasure is entirely ours. So at the outset, the belief that a China plus one is benefiting a clutch of Asian economies being spoken about for the last 24 36 months, what gave you the idea, or what do you give as the idea to think of such an exhaustive note on something like this, which has been discussed, but also doing it very differently, as I've seen?
Yes, it's been talked about a lot, but one of the key questions we keep getting from everyone is, where is the evidence? Right. We don't see it in the data, we don't see it in exports, we don't see it in FDI. So we decided to basically find some evidence. So what we've done is take a top-down and bottom-up approach. The top-down approach essentially looks at some of the top-down data that should reflect countries benefiting from supply chain relocation, and a bottom-up evidence, which is a survey of about 130 firms in terms of which country is investing in which destination, in which product category. So we decided to take both a top-down and a bottom-up approach, put it together, and essentially identify the winners and the trends.
Yeah, and that's fascinating. I can't wait to hear this. So we'll divide this up into two. One is something that you've done in the earlier half of the report is just talk about how this is a very natural progression. Japan did it to Hong Kong, Singapore, South Korea and all did it to ASEAN, but particularly China. And in some sense, China is now doing it to the rest of the Asian countries. So in some sense, this is bound to happen, or this was bound to happen and is now happening.
That's right. So, I mean, the term, wild flying geese is actually a literal translation of a Japanese word, Ganko Kitai.
Okay.
And it was actually named by a Japanese economist called Akamatsu in 1930s. And he did that on the basis of empirical observation for Japan. So he saw that as Japan progressed during that period, it initially was producing more of low-end garments, but over a period of time sort of progressing in the quality of goods that it was producing. And over time, also as costs started increasing in Japan, Japan shifted production to newer countries, so the newly industrialized economies of Hong Kong, Singapore, Taiwan, and Korea. And we've seen since then this natural progression wherein as costs rise, the production actually shifts to lower cost destination. So to that extent, in 2001, when China joined the WTO, China was one of the flying geese benefiting from the supply chain relocation from these newly industrialized economies. And it's done exceptionally well over the last 20 years. But since 2010, costs itself have been rising in China. And we've seen geopolitical trade tension escalation post-pandemic. The big focus for companies has been, how do I diversify my risk? And so I think both a mix of sort of the natural progression you would have anyway seen, but also some of these push factors in terms of diversification of risk has accelerated the China plus one strategy. So what we're basically trying to find is, who is the lead goose, which is, leading the production relocation, and who are the new flying geese which will benefit from this production relocation.
Interesting. And in some sense, Sonal, does this, you briefly mentioned it, but the report speaks about it. I just want to understand this rising US-China trade tensions. Does that accelerate a cyclical phase or a developing phase like this? We know cycles are usually shorter now than what they used to be, but does this kind of accelerate that behavior of the geese taking on from the goose, so to say?
It does accelerate the transition and the relocation of production, which is sort of what we've been seeing in the last 5-6 years. I think the challenge, though, is the enormity of China. And one of the things that we talk about is how weaning off China is very difficult. So when you think about, let's say, textiles, some of the key inputs, so let's say Vietnam is now seeing more of garment manufacturing move, but a lot of the inputs that go into making something actually are still sourced from China. And the kind of, scale, quality, and price at which Chinese manufacturers have supplied, it's very difficult for firms to actually move all of that from China to elsewhere. It's just a completely different scale. So yes, the geopolitical tensions are accelerating the trend, but it's also extremely difficult to completely wean off China because of its scale.
Okay. I wonder if you have any thoughts here, but even if the supply chains are not completely, let's say for a particular set of products, extinguished from China completely and moved to other nations, but even if a part of it happens either due to this supply chain reconfiguration because of the China plus one strategy or because of China's draconian measures during COVID, etc., and people saying that, hey, even if China is cheaper than any of the others, but we just want diversification because it's good for us, dependability, etc., then let's move that. Is that small shift also big enough for the ASEAN nations because of precisely what you said, the enormity of China?
It's big. So China's market share in overall exports, in the goods exports, China accounts for roughly 14-15% of global exports on an aggregate basis. Now, if you take a category like toy, which is a low-cost product, extremely cost-sensitive, China still has nearly 50% global market share in toys. So, a small shift from China is still a big move, a big drop for some of the smaller economies. And of course, as some of that moves to the likes of India, that's also going to be quite significant. I think the one mindset change that has happened from the multinational corporations perspective, because they are the ones who actually, decide what part of the value chain should be in which country, because that decision is based on, what's the comparative advantage of different countries. They want to diversify risk. So the kind of concentration in production we saw in China 20 years back, I think the global backdrop is very different. So it's essentially, I don't want to put all my eggs in one basket. And so there is a diversification of risk. That's one. The second aspect is the industrial policies of developed advanced nations. So US itself is trying to have more of EV battery, and of course on the semiconductor manufacturing fab setup, back in US. So for some of those supply chains, of course, it's going to be a lot more tricky. It might be easier for other products like capital goods or smartphones, but those products is where the advanced economies actually want to bring production back home. So lots of different dynamics actually going on at the same time.
Yeah, and interesting. I'll come to the top-down and the bottom-up piece, but since we're on this topic, what you've said in the report is, one, the sectors in India which benefit, and semiconductor assembly and testing features there, as do smartphones, something that you spoke about. So that is one. I mean, you boiled down upon these based on the flows that have already happened, plus the responses from the companies, or is there some other mechanics for arriving at what sectors will benefit the most in which country?
So it's a mix of, investment intentions have been announced that company X wants to invest in, let's say, India in this product category. Some of that investment may have come in, and a large part of it will come in the future. So it's a mix of both actual and investment intention, but I think a larger proportion is going to be investment intention, and therefore the conversion of that into flows will show up in the data in the coming years, I think.
Which leads you to believe that India, even versus other in isolation, say for Vietnam, the CAGR of exports till 2030 for India could be 10%. Put this into perspective for us, Sonal. 10% looks impressive as a number from the basis that we are at, but please help us understand the magnitude of what this number would mean.
Well, to put this in perspective, if you look at the last 10 years, 2012 to let's say 2023, 2024, till 2023, on a CAGR basis, our exports were less than 5%. And part of that, of course, was the pandemic shock, which was a lost year on exports. We had a degrowth. But that was the growth exports saw during that period. So what we've done is try to identify product categories where India is seeing interest from MNCs to relocate production, because those should be some of the products where exports will do well. And second, we've also tried to assess which are the product categories where India has a higher comparative advantage. So if you have a higher comparative advantage and you're seeing firms actually move to make that product in India, you have a higher chance of growth exports in that particular category. So we've done a bottom-up analysis on the sectoral forecast, based on which we think that over the next 5-6 years, India's exports will grow at 10% on a CAGR basis, which basically translates to exports going from something around $430 billion in 2023 to closer to $850 billion by 2030.
Yep, 431 to 835 is the number that they've mentioned in the note, and that's about a 10% CAGR till 2030. Before we take that break, one more question, Sonal. A lot of people argue that India lost out in the past year, as you mentioned as well, on that manufacturing boom that happened across the world, and lament the fact that, it can never be recovered. I'm just trying to understand, because you've studied so many other economies as well. Has there been a case like this wherein you may have lost out in the past on a global manufacturing boom, but now the country awakens to the importance of manufacturing, as India has, to be fair, in the last 3-4 years, and still deliver a robust competitive growth with manufacturing taking the lead? Because India hitherto has been a services-led economy. Can manufacturing come to the fore? Have there been past examples like this? Any thoughts on the same?
I think what we've seen is some of the ASEAN 4 economies like Thailand, Indonesia, actually took off around the same time when China took off. And China really boomed, whereas these economies were not able to convert. And I think for India, therefore, it is important to understand what is the policy lesson here. And the ingredients that are needed to keep this going. Getting integrated is just the beginning. You have to accelerate the process, you have to increase the quantum of domestic value added, and you have to move up the value chain. In a semiconductor, for instance, if you're doing assembly and testing right now, we want to, over a period of time, move to, making, chips that are lower in terms of nanometer and so more advanced. So it's a journey, it's a process. And during that process, there are lots of policy actions that need to be implemented, both in terms of, the next 1 year, 5 year, but I would say even the next 10, 20 years to ensure we grow and increase our market share in the global value chain. So I think it's a process. We need to work hard to make it happen.
Okay, great. So I'll stay on. We need to take a very quick break. Viewers, what I've done is I've done the beginning and the end of the interview in this segment. The middle part, which is the process that they followed and the responses that they would have gotten from the bottom-up survey that they did, and also the bottom-up interviews that they may have done, and the top-down survey. We'll try and talk about that with Sonal on the other side of this very quick break. Stay tuned. Back with Profit Insights, in conversation with Sonal Verma on the report about the flying geese and the benefits that come in to economies in the ASEAN region, and probably even Mexico or Mexico, as you may want to pronounce it. Sonal, we spoke about it before the break. A quick segue into what the responses of the top-down research that you may have done and a bottom-up conversation of 130 MNCs, if I'm not wrong, that you guys did. Anything interesting that it threw up aside of the headlines, which is that, these are the sectors, etc.? What did it throw up?
So it's a survey of firms based on reports. So a couple of things that came out. One is, of course, Asia is the biggest beneficiary of the shifts in supply chain. And in particular, we find India, Vietnam and Malaysia as the new flying geese. So these are the countries that are attracting most of the production from China or elsewhere. But outside of Asia, Mexico is the biggest competitor for the region. Second, in terms of who is investing where, one of the things that stood out, so we had done something similar back in 2019. So it's interesting to compare then and now. And back in 2019, a lot of the production, the source country, that the MNC were actually US companies, or they were Taiwanese or Japanese companies that were doing reshoring. So they were moving production from China back onshore. This time around, actually, China is the biggest investor. What we therefore would say is, China is the lead goose in this cycle. It is leading here. And interestingly, most of China's investments are in the ASEAN economies, particularly Vietnam, Thailand, Indonesia. So that's actually more China. Whereas when we look at where India is getting investments for, majority of the inflows into India are actually from US-based companies and some of the companies from developed Asia. So we do think that China investment in ASEAN and US investment in India is sort of an indication of sort of the geopolitical alignment that these countries have. Third, let's talk about the sectors as well, because we've looked at which sectors are attracting investment. For India, which is sort of the number one in our survey, the investment attraction is actually fairly broad-based across sectors. So it is, of course, smartphones, but also autos, capital goods, semiconductor assembly and testing, and quite a few others. So it's very broad-based, which is actually in contrast to what we see for some of the other new flying geese. So Vietnam, a lot of the investment is in the EV sector, solar panels, or in the PC on the electronic side. Malaysia, it's largely in semiconductors and in electronics. So I think the broad-based nature of investments that India is seeing is quite interesting this time around.
Okay, could it also be because of the large domestic opportunity that India gives, or not necessarily?
It's definitely a plus point for India because none of the other countries actually have that large domestic market size. So the economies of scale that provides the MNCs in terms of catering to domestic market and using it for export purpose, I think is definitely a positive for India. The other factor that could be playing a role is the risk around further escalation of geopolitical tensions. Trump has mentioned that if he comes back as US president, he's going to impose a tariff, a 10% blanket, 10-15% tariff actually across products, and particularly 60% on China. And if there are loopholes where Chinese companies are shifting production to third countries, then they will also look to put potential tariffs on those countries. So I think from that perspective, since India is getting more diversified source of investment source, you have both an economic as well as geopolitically, actually India is very well placed to attract more investments.
One final point, Sonal, and maybe two-part question rolled into one, is that there are two, how do I say, people who want to throw stones kind of talk about two aspects. One, that, itna kharcha ho raha hai, lekin you don't see the benefit. So any thoughts on that? Part one of my question is that. Part two of my question is, a lot of people compare what, say, China is doing in its investment right now, wherein it is investing in futuristic tech etc. and all, and how India is not doing so. So the part two of my question is this a natural evolution of a country at the stage that India is, that it will probably do this right now and do the high-tech stuff? It is doing some of it, but do the large-scale high-tech stuff only at some point of time in the future. Is it a natural stage of evolution or nothing like that?
It's not a natural state of evolution. There has to be concerted policy effort to make it happen.
Okay.
Otherwise, countries get stuck in the middle income trap.
Okay, fine.
And you know, for instance, you can give more incentives on R&D, you know, higher quality education, training institute, but a lot of that work needs to start now so that we are ready. But it's not natural. A number of countries, very few make it, a number of countries get trapped. So, which is why we have to also focus on here and now, but also the tomorrow. On your first question, and that's a fair point, I think, you know, the point that the PLI allocations are there but has not been used, or while we are exporting more electronics and smartphone, we are also importing more, so the net electronics trade balance is not moving. So, you know, where is it? One thing that we learn by studying history is that this is a process. And typically it plays out in a three-stage process. The first stage is where countries that get integrated in a global value chain actually import a lot more of intermediate goods. And then you assemble it, your value addition is typically low, you export it, but you're importing a lot. So your net trade balance, domestic value addition is generally low. India is in that stage right now. But as you know, you progress, you build the domestic ecosystem, you import less while you're exporting more, so there's some improvement. And finally, you reach stage 3, where your domestic manufacturing has become so competitive that there's a big decline in imports and a significant acceleration on your exports. And that's when the trade balance actually swings decisively on the positive side. So I think India is still in the very early innings, and we should not be too hasty in, you know, coming to a conclusion. That said, we are trying to integrate in a global environment that is a lot more hostile than any of the previous flying geese have encountered. But this is an opportunity. I think we are seeing evidence of that. There's a lot of interest in India. It's a broad-based interest across sectors. We just have to keep it going on the policy front.
Okay, and how long, sorry, last question, how long does this typically take to move from being a mix of export and import to a largely exporting thing? Is it time-based?
It can vary, but typically it can, you know, easily take like 10 years, 5 to 10 years.
And we are in the early stages, so
we
let's
are
not be
very
too
much in the early
hasty.
stages. So, like even in the smartphone, we are trying to increase the domestic value addition component of it. But for instance, in the semiconductor space, as I said, you know, we are doing more of assembly and testing, but we will evolve. We will, you know, we will keep hitting harder in terms of doing better, moving from more crude products to more advanced products within each product category. And the ecosystem needs to build around it.
Got it. Great. So lovely talking to you. Thanks for doing such a lovely report, of course, and for talking about it to us and our viewers. Really appreciate your time today.
Thank you very much for having me.
The pleasure was entirely ours. And viewers, I hope this episode of Profit Insights was as insightful for you as it was for me while I read the report and finally managed to talk to Sonal Verma. Thanks for tuning in.